in fact, we already had this monetary illusion over the past, let's say, 12 months. And usually when we have this monetary illusion spreading, we have rising volatility. So I would say that or we get into this inflationary bust, it's more likely because we will see a correction in the S&P 500. But I would caution everyone to be overly pessimistic on stock because, I mean, everyone must understand and remember that in an inflationary environment, the problematic assets are bonds and cash.
Welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Most of you know me as Triangle Investor from social medias. Joining me today is Laurent Lequeu from Macro Butler Substack. Welcome. It is really great to have you here.
It's my pleasure, Lucian, to be on your show.
Thank you. I'm a subscriber on your subscriber on Substack, and I really like some of your views on the broad economic and commodity topics. And I see that you put a lot of effort into these reports, which I really respect. I would like to cover a few topics today, especially the hot topics. But first we will start with the introduction of you and why should people pay attention to you and your and to your views, so to say.
Well, in a few words, I've been following financial markets for almost 27 years now. I'm originally from Belgium. More than 12 years ago, I moved to Asia. Uh, I've been working in all kind of financial job from private banks to family office. So my recent move is to become an independent advisor and to write the Macro Butler newsletter. So the reason that I move as an independent advisor is that I wanted to bring kind of a tailor-made and independent view of the world to my clients. And to summarize how I see the world, I look at financial market through the lens of the business cycle and how investors should allocate their portfolio in the different stage of the business cycle.
Yes, I would like to hear your current economic view of the economic landscape and how do you see it at the moment, and maybe some expectations for 2025.
Well, so to address the business cycle, in fact, there are basically three market ratio that matters. So the first one is the stock market to oil ratio. So I will take the example of the US, but you can use it in any market where there is a tradable asset. So I look at the S&P 500 to oil ratio, and as of today, is still above the 7-year moving average. So we can still say that the US economy is an economic boom. But I would say that over the past few weeks and months, this ratio has declined and is heading towards the 7-year moving average. So I guess that here the key point with what will be the trigger for the S&P to oil ratio to break below this 7-year moving average. And of course, everyone is looking at Trump and the tariff that most likely will be implemented in the next few weeks or months. So this could be the trigger for this ratio to break below the 7-year moving average. Then if we look at the other key ratio that matter is the gold to bond ratio. I mean, that ratio in the US and everywhere in the world, in fact, has been above its 7-year moving average since the start of this decade. So whatever the governments or the central banks are telling the people, in fact, the global economy is still in inflationary mode. And so if I take the example of the US, the US is still in an inflationary boom. Now there are a third ratio, which is usually a leading indicator of what's going to happen, is the S&P to gold ratio. And here, in fact, as of the end of January 2025, it has just broken below its 7-year moving average. So if you look back in history, there's kind of this ratio is kind of a leading indicator for the S&P to oil ratio to break below its 7-year moving average. There's around 6 to 9 months delay between the two ratio. So I guess that in a nutshell and in a few words, the US is still in an inflationary boom, but the party is about to be over, and we are moving slowly in the US into an inflationary bust. So inflationary bust is the politically correct term for stagflation.
Okay, so in your models, in your opinion, do you see a market correction anytime soon or even market meltdown?
Well, I would think that if we look back at history, when this S&P to gold ratio break below a 7-year moving average, it's when you have what I call the monetary illusion, meaning that you can still see the stock market rising, but when you measure the performance of the stock market in gold terms, in fact, it's declining. And this is what we have in 2024 in the US. If you look at the performance of the S&P 500 in dollars, it was up more than 20%, but in gold term, it was down. So in fact, we already had this monetary illusion over the past, let's say, 12 months. And usually when we have this monetary illusion spreading, we have rising volatility. So I would say that or we get into this inflationary bust, it's more likely because we will see a correction in the S&P 500. But I would caution everyone to be overly pessimistic on stock because, I mean, everyone must understand and remember that in an inflationary environment, the problematic assets are bonds and cash. So you want to own cash to reduce the volatility of your portfolio, but bonds is clearly not the asset to own. So if you cannot own bonds, what else you have? You can own gold, you can own stocks. So I would think that to come back on the stock market, I see higher volatility in the next 12 months. I see a sector rotation. So I see a sector rotation from the Max 7 and the tech stocks into, I would say, the more traditional companies like the Dow stocks or the oil and gas sector or the mining sector or the industrial sector. So I guess that all in all, you could see a pullback in the index, but you are going to see a big divergence between sectors, and 2025 is not going to be what 2024 was, meaning that in 2025, I mean, you don't need to own this Magnificent Seven. What you need to own is other stocks which have a quality balance sheet, a proven business model, and which are able to pass through higher input costs to their customer.
Okay, you mentioned interesting thing, and that is holding cash. So you would advise people to hold cash positions. So the era of cash is king is maybe back or not?
Well, I would say that people must be very cautious in holding cash because I would say, again, if you look at the performance of cash versus gold, I mean, clearly gold was the king over the past 2 years, and cash was not was a catch. And here, I would think that cash must be held on a tactical basis,
Mhm.
especially when we see this rising volatility in the gold market and the equity market, because I think that the volatility will increase as well in the gold market. And also there are, I would say, good ways to manage actively your cash. So I recommend to my clients to hold short-dated investment-grade US dollar bonds, meaning that you look at these good quality companies, triple B and over rated with a duration of less than 12 months. And this portfolio can give you a return which is around 5 to 5.5% annualized. So it's a way to actively manage cash. And it's also a way to avoid to have too much cash on the bank account, because one day the risk of a banking crisis or a bank run in the US and in Europe, in particular in Europe, I think that the risk of a banking crisis is much higher. So you don't want to own a lot of cash on your bank account, because I mean, people always forget that when you own cash on your bank account, you take the counterparty risk of your bank.
Yeah, what about physical assets? How would you structure your physical assets going forward? I mean, okay, obviously gold. What else?
Well, I would think that in gold, in fact, in the physical assets, sorry, in most of it should be in physical gold. In fact, if you look at the other precious metals, silver, platinum, palladium, they are trading at extreme cheap valuation against gold. So there's probably a catch up to happen on these other precious metal. But yeah, I would think that investor must be also aware that silver, platinum, palladium have a much higher volatility than gold. So they must be ready to stomach this higher volatility. I would think that ideally everyone should own between 35 and 50% of physical asset, meaning that uh, physical gold, silver, platinum, and palladium.
Okay, when you say you expect volatility in gold, why is that? Do you see central banks persist in buying gold? Do you see any other triggers that could move the price up or down? What triggers do you see in your
Well,
models?
I think here you need to make a distinction between the global south or the BRICS and the rest of the world. So I think that I mean, if Trump implement tariff and other measure that continue to weaponize US dollar asset, you will continue to see central bank in the global south and the BRICS countries increasing their gold reserve and buying less or even selling US treasuries. So this will be the big support for gold price. But I would think that I mean, tariff will have a global impact, will impact the economy everywhere in the world, and ultimately the US will also be impacted. But first will be the countries that are, I would say, affected by the tariff. So if these countries are showing a slowdown in the economy, they may be also forced to slow down in buying gold as their reserve. So I would think that's why I would say that we will see higher volatility. I would think that I cannot rule out a 10% pullback on the gold price, but this would be a very good tactical buy opportunity.
Yeah, so long story short, you expect the tariffs will cause the global recession. Did I get it right?
Yes, I mean, the tariff will ultimately cause a global stagflation, meaning that the inflation problem will get worse, and at the same time, this will impact consumption in China, in Canada, in Mexico, in other countries that will face tariff, and ultimately it will impact the consumption in the US, because the US consumer will have to pay also the price of the tariff. And so I would think that uh, we will end what I call the Trump stagflation, meaning that Trump 2.0 will be remembered as the global stagflation before the end of this decade.
Okay, what about the currencies? How do you see currencies performing in that kind of environment? I mean, the US dollar, Canadian dollar, euro. British pound. How do you see that?
Well, I mean, again, here, if you look at past history, I mean, past inflationary burst or past stagflation have been very positive for the US dollar. The implementation of tariff and trade war are, in fact, very positive for the US dollar against all other fiat currencies because if you reduce trade between the US and the rest of the world, in fact, less US dollars will be generated. And in the problem of the global south today is still that it has a massive debt level in US dollars. So the global south needs US dollar to reimburse its US dollar denominated debt. And if there is less US dollar generated by global trade because we are in a trade war, I mean, the value of the dollar will go up, and because there will be kind of a scarcity of US dollar. So on this point, there's something that I want to mention, which I think is interesting, is that a few weeks back at the end of November, Chinese banks have raised US dollar, have issued a US dollar bond in Saudi Arabia. So, I mean, by this, Chinese banks were able, in fact, to get US dollar outside the traditional US dollar system. So this could be a solution for the global south if other US dollar bonds can be issued by Chinese bank in Saudi Arabia or elsewhere in the global south. But in general, I would say that the tariff and the stagflation that will follow is very bullish for the dollar against other fiat currency, but it's bearish for the dollars against gold and other physical assets.
Yeah, do you see, are there any winners from this trading war, or they are all losers?
Well, if we are in a trade war, meaning that China retaliate when US put tariff and US retaliate after China put new tariff. So, I mean, in this context, there's only losers. It's a lose-lose situation for everyone. And I think that's what Trump doesn't really understand is that, I mean, global wealth and wealth in the US is created by free trade. And the American companies went overseas, they went to produce in China, they went to produce in Vietnam, they went to produce elsewhere in Mexico or anywhere in the world because the cost of producing in the US were higher because the tax in the US are higher. And so you cannot really change this. I mean, the trade war will not solve the problem of the US per se. It will just create more tension in a multipolar world. It will only increase this trend of the weaponization of US dollar asset. So at the end of the day, this will be a lose-lose situation for every country. And that's why I say that, I mean, Trump will be remembered as the Trump stagflation, meaning that the 2020s at the end of the day could easily look like the 1930s in the previous century.
Yeah, in this war, personally, I see commodities winning. I mean, we will have a lot of, especially the commodities that are crucial, like copper, uranium, you name it. So, do you believe that the commodities super cycle could get a fast track here?
Well, I agree with you on commodities. I mean, commodities, price of commodities are mostly driven by, I mean, what trigger the higher prices in commodities most of the time is shortages, right?
Yeah.
And if you put trade barriers, in fact, you create shortages. So you create a good environment for higher commodity prices. And therefore, I would think that uh, the winner of this stagflation, if we can call it of this, would be physical gold, precious metals, and ultimately the commodity prices. I mean, hard commodities, but I also think that in fact, soft commodities are at the start of a bull trend.
Yeah. How do you see Bitcoin, cryptocurrencies, going forward? Do you see a future for them?
Well, I look at Bitcoin, and try to find a reason to own Bitcoin through the business cycle. And in fact, here, if you look at a simple ratio, which is the Bitcoin to gold ratio, it usually peak when the Nasdaq peak. So in fact, owning Bitcoin or owning the Nasdaq doesn't really offer anything in terms of asset allocation. On this matter, I would stay away of Bitcoin because I would think, people who are interested can go back to my Substack. I've written a detailed research on this a few weeks ago. In fact, as I said, if we are moving into a stagflation, and unfortunately for Bitcoin, we don't have a long track record of history of data, but a stagflation is negative for Bitcoin, and that's why one of my 10 predictions for this year is in fact that gold will outperform Bitcoin in 2025.
Nice. I hope that as well. I want to ask you about your portfolio allocation. I would not ask you any names because that's probably for the premium subscribers. But how do you allocate your portfolio in the terms of commodities, if you can name?
Well, I would say that in terms of the commodities and owning the commodities per se, as I said, is gold, silver, and platinum. As I said, this should be today around 35 to 50% of a diversified portfolio. And the rest of the portfolio, so yeah, let's say to make it simple, the other 50% should be some cash on the sideline to benefit from the volatility. And the equity side, in fact, investors should focus on commodity producer, especially energy producer. So here we can look at the oil and gas sector, but also every industry that is related from far or near to the commodity cycle. So I think of industrial stocks, companies in the mining industry like copper mining, uranium mining. These should be now, I would say, more than 50% of your equity portfolio. Let's say the other 50% of the equity portfolio should be blue chip names that have a long track record of being able to pass through higher input costs to their customer.
How do you do your due diligence on, you named few commodities, gold, uranium, and others. How do you, what are the most important metrics that you take in consideration when doing a due diligence on certain companies?
Well, I mean, if I look at the companies, I think that my opinion is that 10-year yield are moving much higher, whatever the new US Treasury Secretary wants and say. We will see much higher 10-year yield, meaning that the cost of financing for every company is going to increase. So one big criteria that I have when I select stocks is to look at the balance sheet. I don't want to have companies that are over leveraged.
Mhm.
I want companies that generate a lot of free cash flow. I want to see companies that have been able to see diminishing interest expenses over the past few years. And I want to see companies that have very low debt to refinance in 2025, 2026, and 2027 and 2028, meaning over the next 4 years, the amount of debt to refinance should be minimal. And that's the basic of selecting companies in general. So looking down at the commodity sector, I would think that uh, in the commodities sector, you need to be the low-cost producer because nobody knows when the commodity cycle move up or down, even if we can assume that the next move is up in most commodities. But I would favor low-cost producers and leaders in each of their own commodities.
Good answer. How can investors and people reach out to you and become your subscribers?
Well, they can look at the Macro Butler. You can Google it. There's a free newsletter which is published every week. And then if they are interested, they can reach out to the Macro Butler. There's a contact email there where they can know more about my service at the Macro Butler, or also at my service for high net worth individual.
Thank you very much for this chat. It was a very interesting chat, and I hope to host you sometime soon again. Thank you.
Thank you very much. My pleasure.